So I think with that in mind, I'm now very delighted to call on stage Ram and Folaseto to join me for a conversation about more of this. You're going to hear from the investors themselves. Good. Thank you, guys.
Thank you.
Good. So here we are, another FHS, and then this time in Cape Town. I guess looking back on last year, how do you think things have changed, the investment climate? We can sort of see a lot of global sort of changes. It's a chaotic world, and we find ourselves, but within Africa, I mean, how do you sort of feel the changes have been to the investment environment compared to last year? I'll start with you, Seto.
Okay. I would say just looking at our markets, we've seen a lot of improvement and growth in the key markets. So if you look at Lagos has performed really well. Casablanca has performed really well. Even Dar es Salaam in Tanzania has performed really well. But if we come down to Nairobi, because of some of the US aid funding withdrawal, that's a very big donor market. We've seen a bit of it. While Kenya was coming out strongly out of COVID, what we've seen in the last year is that, the first was the riots, and then the second with the withdrawal of the US aid funding, we've seen a bit of a slowdown in that market.
But, I mean, that's a fantastic point. I guess that's one of the challenges that's inherent in an emerging market, because you often have these events that happen not always at the best timing from a supply cycle. We also heard 10 new openings last year in Nairobi, and these things compound, right? I mean, Cape Town and South Africa, a good example, post-2010 World Cup, also corresponding with the global financial crisis. So I guess it's tough to sort of align those sort of tailwinds, headwinds, and supply and demand imbalance, right?
Yes, that's right, yeah.
Ram, any thoughts compared to last year? I mean, how do you sort of see the investment climate across Africa?
Yeah, I think we had a good summary of the pros and cons of a lot of the markets. Overall, though, you can have a big speech prepared of what's happened in the last 12 months, but the big story is always Trump, even in Africa. I think it's been net positive, some of the uncertainty created around the world, because the dollar has not been as strong, which means that some of the currencies have had a chance to recover a little bit more. But of course, the big story now is going to be what happens in the Middle East. That I think, as investors, we look to the future. It's good to have the historical numbers and what's happened the last 12 months, 2 years, 3 years, and I hope that next year we don't talk about the 2019 as a reference point for hospitality anymore, and we move forward from that. But I think the real concern and the real what we have to focus on now is how is this all going to pan out in the Middle East, and how it's going to affect our markets. We count on tourism, we count on air connectivity, on arrivals. That's really going to be the driver. But overall, from the last 12 months, I think what the return of Trump has really brought to the fore is a realization from many governments that they need to band a little bit together away from this dependence from the US. It is painful. It is painful in all kinds of industries, including in ours. But hopefully it will be a net positive, I really hope, in the medium to long term.
Yeah, absolutely. Yeah, I guess that is the essence of it, right? It's and that's the topic today, is high risk, high reward. I mean, Seto, do you agree with this statement? And I guess looking at the risks, sort of strategies around mitigating some of these. I mean, what are your views on some of these sort of ways in which to sort of go about it, to mitigate some of the risk?
So I do agree that it's a high risk sector. While it's a high-risk sector, I would say that you can also get outsized returns, and it really depends on what area of the value chain, I guess, you're investing in. So the way I look at hospitality is you have the greenfield investments, brownfield investments, and investing in operational assets. And our strategy is to invest in operational assets where we believe that, some of that risk is a bit de-risked in that sense, and then just focus on, rebranding the assets, whatever relevant CapEx programs you need to deploy, and then just trying to stabilize the assets. So we just focus on yield stabilization for the most part. I would say that in terms of mitigations for the sector, one would be finding the right operating partner. I think that's very critical as you look at investing in hospitality, especially in a region like Africa. While you can do everything right, there's sometimes, you sometimes have these curveballs that are thrown at you. For instance, I mentioned Kenya with, some of the challenges that have happened in recent times.
Yes.
I think the other thing is really, having a very tight and organized CapEx program, so that you don't end up, overspending on CapEx and, dealing with cost overruns. And I would say the other thing is, as you look at debt financing on your assets, thinking about the right level of gearing, especially as, there's a lot of currency volatility in this space, in the markets we operate in. So just putting the right level of gearing is very critical to ensuring stability of the assets and mitigating your risks.
Yeah, absolutely. And I touched on that earlier around this cycle not being sort of one where we have that low cost of capital and perhaps better for Africa. But I think it's a good time to actually be in real estate because returns are going to be about income growth, engineering income growth. It's a fantastic time globally to be sort of in asset management and real estate because of that. Very little to do when you've got such cheap cost of capital in the previous cycle. But I guess that's really a hallmark of this sort of sector, that ability to take yield at very low levels. And it's important that year 1, 2, but really sort of where you're going from a stabilization perspective, quite different for Africa. Ram, anything just around that thesis and ability to engineer and grow income asset management, is that's still a big part of the strategy, right, to mitigate?
Absolutely, and it's always been a key part of the strategy. And I think where I'll disagree a little bit is with the premise of the panel, hospitality being high risk, high reward. I actually don't think it is high risk. I think it's framed as high risk historically because of the nature of ownership and some of the cycles that have ensued. But in reality, when you decompose hospitality, to us at least, it's the best of both worlds. You have the downside protection of real estate, and you have the operational leverage of an operating business. What do I mean by that? You can take a hotel that is not in a perfectly fantastic location, but with an absolutely amazing team, you can attract corporates, airlines, leisure business, depending on which city you are. So really, we see hospitality as having very strong inbuilt hedges that protect you from things like inflation, currency volatility, and so on, while still enabling you to do that operational leverage. Where you're absolutely right is the asset management component, yield growth, focusing on the cash flow. That has been historically not as much a focus of the various stakeholders in the sector. From the beginning, we've taken a view that asset management is a key component, is a key focus, and we've seen it in some of our hotels actually, that we don't necessarily need to always buy in the best location. I mean, it helps, but having the best team definitely pushes the yields forward. And we are in a time of the cycle now where, given all the uncertainty, we have to double down on that strategy.
Yeah. Absolutely, and I guess the other thing which we sometimes are guilty of sort of painting a sort of similar homogeneous macro kind of story, right? 54 countries, very nuanced, all at very different stages of their cycle, and within cities and markets, right? One street corner very different to another, but to sort of at least kind of touch on kind of the markets where you're sort of seeing most opportunity. So you touched on some of the challenges, I guess, from a Nairobi perspective. But where maybe sort of where do you sort of see 3 markets that are sort of looking positive from a fundamentals point of view?
I mean, being Nigerian, I may be biased, but I think the Abuja market is a very compelling one. There's only two like big international, I mean, two major properties in the market. It's just not enough for the demand. And it's becoming more and more of a conference hub. A lot of international conferences coming into the market. There's, good, decent political stability now, currency stability. So I think this is a good time to look at, the Abuja market definitely needs more international brands and good quality assets.
Yeah.
I would also say, just based on our experience and the markets we're in, I think Casablanca is very strong. I guess the Casablanca-Marrakesh corridor is one where, I think there are definitely opportunities. It's a good hub. It's, strong financial hub. Also very good travel gateways and visa processes. So I think, for me, that remains a very strong and attractive market. And for the last one, I would say Cairo. I think, just given the size of the market, the size, it's outsized relative to the rest of the continent in terms of tourism, the contribution to GDP. I would say that Cairo is, remains a very attractive market.
But it's a somewhat sort of, there's two sides of this coin, right? And I think a market like Nigeria epitomizes it. The extent of uncaptured demand is incredible, right? If you look at the number of keys to GDP, it's got to be sort of the lowest in the world. But to develop a new full-scale brand standard hotel today, the price, incredibly tough, right? So there's a barrier to entry there from a development point of view. There are few sort of investment-grade assets. It's going to be pretty good times for those that are owners, right, with these barriers to entries in certain markets, right? So I think that's got to be part of the thesis for those that can still develop at a reasonable development cost. Great, but I think that's the cycle's kind of really sort of ramped up in some of these markets from a development cost point of view, right? So, and to your point, you focused on the operational assets, right? Yes. But there's a shortage of some of these investment grade assets in some of these higher growth markets, right?
Yes, correct.
Good. Ram, similar question to you. Markets are sort of focusing and I guess touching more on sort of what are the fundamentals you see as being attractive to those to markets. Yeah.
No, yes, and we look at investment markets two ways: top down and bottom up. And for us, top down is we start by some of the macro factors you've had in your presentation and STR has shown, which is what is the RevPAR growth, what is the arrival situation, what is the airline connectivity, are those going in the right direction? And bottom up to say, well, once the hotel generates enough profit, can we take those profits out? So is some of the taking out the currency, the macro a little bit favorable, right? And from all those perspectives, what we realize is, to be honest, many markets can be interesting, but the most interesting markets are where we can build scale in one way, shape, or the other. And hospitality is going to be one of these sectors which is going to go through a period of transformation where scale is going to matter a lot more than just straight RevPAR growth or some of these airline connectivity. Why do I say that? Is because we know that these numbers are very macro, but on a micro level, neighborhood to neighborhood, some hotels perform a lot better than others because there are certain characteristics. I mean, you take a Casablanca, some neighborhoods perform a lot better than others, even though the numbers don't show.
And those fundamentals shift, right, and change. So you're kind of diversifying even from a nodal point of view.
Yes, and exactly. So I think the goal that we have at least is how do we build that scale, would increase the knowledge base in each of the markets we are today. But I think I generally echo the sentiment. I mean, there's markets that have been ignored or historically and that have been tough performing, like Nigeria. Definitely are key interest. Yeah. And then from a top perspective, you have places like Dakar, Senegal, which has done really well on a RevPAR perspective. Continue to look there. And Mauritius is another market which is very different from the rest of the continent, but still is part of Africa, but has done also well in the last couple of years, and that's a place where we don't have any assets today, but I think we continue to look very keenly at some of those markets.
Great. Yeah, absolutely. And different fundamentals, I guess, from a leisure perspective. I mean, the resort sector gives you that 18-month booking window that you really have good line of sight as investors to how the asset's going to trade through that period. But I guess, if we look at the sector, and DFIs have been sort of pretty active historically, and their mantra and role has always been to sort of institutionalize the sector. If we sort of take that kind of frame and sort of look at exactly that, how do we institutionalize this sector beyond the performance narrative and getting those occupancies and demand up and the transparency? How do we take it sort of forward from a sort of institutionalizing perspective? So any thoughts on that?
I would say education and talent development is very key. We don't have enough, hospitality schools. We don't have enough vocational training. The brands have done less in terms of just, the training that used to be available, a number of years ago. So there needs to be a lot of training and just general knowledge of the sector. I think that's, going to be really key in terms of institutionalizing the sector. I would say standardization and data transparency is very key. Standardization and availability of data such as ADR, such as your RevPARs, your occupancies. I think that data will be very, very important in terms of just helping to institutionalize the industry and just, if you have access to high quality data, then you can make more informed investment decisions. So I think that's very critical. Another thing I would say, and I mean, we can't emphasize this enough, is just, the regulation, the legal and regulatory framework. And, the private sector and the public sector have to work together to try to achieve this. Just looking at different things such as visas, access to visas, air traffic control, security. In Nigeria, for instance, security is a big issue in terms of attracting tourism in the sector. But, private sector and public sector have to work hand in hand to be able to achieve this together. And I would say another area is ESG integration. Trying to, we have done quite a lot in that space, just, by virtue of the fact that our investors are, we have DFIs and investors where ESG is a very big factor in investment decisions. But, I think incorporating ESG into the way we run the hotels, into the way the hotels are managed, we're tracking ESG data and we're ensuring that, the hotels are being a lot more sustainable. I think that would definitely help with institutionalizing the sector.
Absolutely. I think those 2 points, the market data and sustainability, are the 2 areas in our GRETI index where African markets tend to perform sort of the worst, right? And it's not that they aren't sustainable investments, it's the measurability and the sort of quantifying of that for investors. But coming to ESG and RAM and an exciting sustainability-linked loan in Senegal that you've just concluded, I mean, it's probably one of the sort of first ones in hospitality across Africa. Tell us a bit more about that, because I think really sustainability is so key when it comes to institutionalizing the sector.
No, absolutely. And I love that deal because we were doing a normal loan. And what we realized with that normal loan is that this bank had... Is
there such thing as a normal loan?
Well, a hospitality loan, if we can call it normal, which is always its own complications. But we realized through that process that the bank had this sustainability arm, and we sort of got to know of them. They reached out to us, and we realized that we were doing everything in our assets that the sustainability team was looking for to implement this loan. So we were almost ready to sign, and we delayed it by a couple of days to put in place a small amendment, small appendix, and say, okay, let's look at what performance targets, sustainability performance targets we're doing on our property, and add it as a characteristic of this loan. So it's really things we were doing already and we're doing across our assets, and seeing how that can benefit not only the people that work in the hotel, but also the lender, which in turn forms part of a different ecosystem. So part of the answer to your question is also debunking the sector, and that's what we do a lot of times with some of the partners we work with. But in this case, we link this loan to 3 criteria, and again, we were already working on, but now we get an additional benefit from it. So it was energy intensity of the hotel, food waste. So we track food waste on a gram per cover basis and gram per guest basis, and number of local suppliers that we use, and number of products that those suppliers bring. This was a hotel we had acquired, so they went from 0 local suppliers to like over 50 or 60 local suppliers with a range of local products. And we're very proud of this because we were doing it, and we got a benefit from it. We get a good publicity from it, and we get to showcase, as you said, it's the first one in hospitality, showcase that this is possible.
Yeah.
It does take an effort of informing all the different stakeholders in the hospitality sector, which don't always are aware of this. But what it also demonstrates is that people are willing to listen and to care and to work with you to make what is a difficult loan possible.
But that's really interesting, in that you were sort of already there, and I think so many people probably are in the same boat. I mean, hospitality is an inherently impact-focused investment, right? But it's the measurability. It's taking those 3 areas, quantifying where you shift from to, and being able to sort of justify that. We're effectively out of time. It's been fantastic to have the 2 of you here, and to continue the discussion through the rest of today. Thank you, everyone. Fantastic.
Thank you.
Thank you.